All right, let's talk about something that trips up so many students in their exams, AS-3, the cash flow statement. Look, this is a super important standard, and really getting a handle on it can make all the difference. So let's get right into it. Okay, picture this. You're sitting in the exam hall. You open up the paper, and you see a company's profit and loss statement. And boom, a massive 5 crore rupee net profit. You're thinking, wow, this company is doing great, right? Well, maybe not. Because right after that, you look at their balance sheet and you see the bank balance is practically zero. So what happened? Where did all that money go? This isn't just some trick question. This is a real-world puzzle that gets to the very heart of a company's health. How on earth can a company be so profitable on paper but have no actual cash? And the answer? It all comes down to a really critical difference between profit, which is an accounting idea, and actual physical cash sitting in the bank. And AS-3, the cash flow statement, is the tool we use to solve this mystery. It's like being a detective, following the money trail to see where it really went.
So let's start with why we even need this statement. How does it help us solve that profit but no cash problem?
Well, here's the official word from AS-3. A cash flow statement is all about explaining the changes in a company's cash and something called cash equivalents over time. But the real magic is how it does this. It sorts every single cash movement into one of 3 buckets: operating, investing, or financing activities. Okay, so before we can start sorting, we have to know exactly what we're sorting. What does AS-3 mean by cash and cash equivalents? Seriously, this is the absolute foundation of the entire statement, so we have to get this right. So it's really 2 parts. Cash is the easy bit. It's the physical cash you have on hand and the money you have in the bank that you can pull out whenever you want. Cash equivalents, though, that's a little trickier. The best way to think about these as investments that are so safe and so short-term, they're basically cash. We're talking about things that are super liquid, meant to meet your immediate cash needs. Now, pay close attention, because this slide is a major ICI favorite. This is where they try to trip you up. For something to be a cash equivalent, it has to pass 3 golden rules. First, you have to be able to convert it into a known amount of cash easily. Second, there has to be an insignificant risk of its value bouncing around. And third, and this is where so many marks are lost, it has to mature in 3 months or less from the date you bought it. Not the balance sheet date, from the date of acquisition. That's absolutely crucial. And that leads us to a massive exam trap. Let's say a company takes money from its checking account and puts it into a 60-day fixed deposit. Is that a cash flow? No, absolutely not. And here's why. Both the bank account, which is cash, and that 60-day FD, which is a cash equivalent, are inside the same bucket. You haven't spent or received cash. You've just moved it around within your cash management. It's not an operating, investing, or financing activity. Okay, so now that we know what we're measuring, let's talk about how we measure it. The entire cash flow statement stands on 3 pillars: operating, investing, and financing activities. This table gives us a really simple way to think about it. Operating activities, that's the main engine of the business, the day-to-day stuff that makes you money. Investing activities, that's all about building or shrinking the factory, buying or selling the long-term assets that help your engine run. And financing activities, that's about getting the fuel for that engine, raising money from owners or lenders, or paying them back. All right, let's dive into the most important one first, operating activities. This section tells us how much actual cash the company's core business is generating. So what goes in here? Well, it's pretty much what you'd expect. Cash coming in from customers, cash going out to suppliers and employees. Now, one thing to watch out for is income tax. Normally, income tax is an operating activity, but, and this is a key point, if you can specifically tie a tax payment to an investing or financing activity, like say capital gains tax from selling a building, then it gets classified there instead. Now, AS-3 gives us 2 ways to figure this out. The direct method is simple. You just list out your cash receipts and cash payments. Easy. But the indirect method, which you're going to see way more often in exams, is more like being a detective. You start with that net profit number from the P&L, and you adjust it for all the things that aren't cash, like depreciation, to work backwards and find the real cash flow. Okay, on to our other 2 pillars, investing and financing. These tell the story of how a company is planning for its future and how it's paying for that growth. Investing activities are all about long-term assets. You know, buying or selling property, plant, and equipment? That's the classic example. It also covers buying or selling shares in another company. And here's a crucial point. For a non-financial company, giving out loans and collecting repayments on them is also an investing activity because you're essentially using your cash to make an investment that generates interest. And that leaves us with financing activities. This is all about the money you get from owners and lenders. So when you issue new shares or debentures to get cash, that's a financing inflow. When you pay back a long-term loan or redeem some of those shares, that's an outflow. And, very importantly, paying dividends to your shareholders is a financing outflow because you're returning cash to your capital providers. Okay, enough theory. Let's get our hands dirty and see how this stuff actually works in a real ICII exam question. This is where you really win or lose marks. So here's a classic scenario for you. A non-financial company gives out 3 different loans. One goes to a supplier, one to an employee, and one to its own subsidiary. How would you classify the cash outflow for each of these? Just take a second and think about it. All right, so here's how ICAI twists this concept. It's all about the why. A loan to a supplier or an employee is seen as part of your normal day-to-day business operations, so that's an operating activity. But a loan to your subsidiary, that's totally different. The purpose there isn't day-to-day operations. It's to invest your capital to get a return. And that makes it an investing activity. See the difference? Let's keep going. Buying shares in that subsidiary, that's a no-brainer. Clearly an investing activity. But what about dividends? This is a key distinction that you have to know. When you receive a dividend from an investment, it's a return on your investment. So that's an investing cash inflow. But when you pay a dividend to your own shareholders, you are returning cash to your financiers. That makes it a financing activity. Getting this right is so important. And what about tax? The rule here is actually pretty simple. The tax follows the transaction. Just think of it like this. The tax payment is directly tied to whatever caused it. So if tax is deducted on interest you earn from an investment, that tax is an investing outflow. If tax is deducted on interest related to a supplier advance, which is an operating item, then the tax is an operating outflow. Easy. And finally, let's look at something unusual, an extraordinary item. Say you get an insurance payout for a fixed asset that was destroyed. Where does that cash inflow go? Well, the cash is directly related to a fixed asset, which is an investing asset, right? So the cash inflow is classified under investing activities. But because this is a one-off, unusual event, AS-3 also says you have to disclose it separately. And really, that's the whole point of a cash flow statement. It tells a story. It shows you exactly how a company is really generating its cash and where that cash is going. So next time you see a big profit number, remember to dig deeper and ask, okay, but what's the cash story? Okay, let's be real for a second. You know that feeling, right? You've spent hours on a single cash flow problem. Every ledger looks perfect. You've double-checked every single calculation, and still it just won't tally. That final number is off, and it's absolutely maddening. Trust me, I get it. And you know what? Here's the crazy part. The whole thing often unravels because of one tiny detail. It's a classic ICAI exam trap. A single, small mistake in the provision for tax account, bam, it sets off a domino effect that destroys your entire solution. This is exactly where so many students lose crucial marks. So here's our mission for this session. We're going to take this exact problem, illustration 7, right from the ICI material, and we're going to turn these static, boring balance sheet numbers into a dynamic story. We're going to figure out exactly where the cash came from and where it went. That is the real power of a cash flow statement. Okay, you think you've got it? Time for a quick test. Let's look at this table. It's straight from an ICII scenario. Brokerage paid on the purchase of investments. What do you think? Well, it's part of the cost of acquiring that investment, so boom, investing activity. What about underwriting commission paid? That's a cost of raising money, right? So financing. Trading commission received? If you're a brokerage firm, that's your bread and butter, so operating. Purchase of goodwill? Definitely investing. Redeeming preference shares? That's all about capital structure, so financing. And last one, rent received from a property you hold as an investment? That's a return on your investment, so it's an investing activity. See? Getting these classifications right is honestly half the battle. Now let's tackle what's often the most complex part, operating activities. And AS-3 actually gives us 2 different ways to present this section. So you've got the direct method and the indirect method. The direct method is, well, direct. It's super simple. It just lists out cash you got from customers, cash you paid to suppliers. It's really clear. But, and this is a big but, the indirect method is the one you have to master for your exams. This is ICAI's favorite for sure. This method is a bit like being a detective. You start with the net profit from the P&L and then work backward, adjusting for all the non-cash stuff like depreciation and changes in working capital to finally figure out the actual cash from operations. All right, deep breath. This is where it all comes together. In Section 4, we are going to build a complete cash flow statement from scratch using our old friend Illustration 7. So when you're using the indirect method, where do you even begin? The absolute first step, the non-negotiable starting point, is calculating the net profit before tax and extraordinary items. Look at the working note here. We start with the difference in the P&L balance from last year to this year. Then, really important, we add back the provision for tax and any proposed or paid dividends. This number we get, it's the starting block for the entire operating activities section. You get this wrong, everything that follows is wrong. You just cannot skip this step. And here it is, the moment of truth, the final payoff. We take the net cash flow from operating, add or subtract the net from investing, and do the same for financing. What do we get? A net decrease in cash for the year of $4,500. Now we take our opening cash balance, which was $8,500, subtract that $4,500, and we get $4,000. And what's the closing cash balance on our balance sheet? It's $4,000. It matches perfectly. That right there is the magic moment. It tallies. Okay, we've built one. Now let's get into the good stuff. Section 5, decoding ICI's favorite traps. I need you to pay very close attention here. This is where easy marks are either won or lost. All right, trap number 1, current investments. Your brain sees the word current and immediately wants to lump it in with cash equivalents. Don't do it. That is a classic ICII trap. The official guidance is crystal clear. Unless the question specifically tells you that these investments are readily convertible and have insignificant risk, you must treat them as an investing activity. That means their purchase and sale go into the investing section, not as part of your opening and closing cash. This is a huge, huge point. Please remember this. Trap number 2 is all about interest calculations, especially when new debentures are issued partway through the year. So, do you calculate interest on the opening balance, the closing balance, something in between? Here's the deal. The examiner actually gives you some flexibility, but you have to be clear. The rule is simple. Pick a reasonable method, whatever it is, and then, this is the most important part, state your assumption clearly in a note. The key takeaway is this. You must write a note explaining how you did it. No note means no marks. Simple as that. Okay, now for a really tricky one, inventory revaluation. The question might throw you a curveball and say something like, opening inventory was undervalued by 10%. This is a double whammy adjustment. It has a 2-part impact. Part 1 is obvious. You calculate the amount of the undervaluation and add it back to the opening inventory figure. Easy. But here's the part everyone forgets. If you understate your opening inventory, you've also understated your opening profit from the previous year. So you have to take that same undervaluation amount and add it back to your opening P&L balance as well. If you miss that second adjustment, your whole operating activities calculation is going to be completely off. All right, we're on the home stretch. Let's move to our final section and lock in all these concepts with a quick fire revision. Ready? Let's do this fast. What's the standard? AS-3. What's cash? Cash in hand plus demand deposits. Cash equivalents. Short-term, highly liquid investments. What are the 3 activities? Operating, investing, and financing. Operating, principal revenue activities, your core business. Investing, buying and selling long-term assets and investments. Financing, all about owner's capital and borrowings. Got it. And one last thing for operating activities, remember there are 2 methods, direct and indirect. But let's be honest, your exam prep should be 99.9% focused on the indirect method. That's the one that starts with net profit, the one with all the adjustments. Why? Because that's how the examiners really test if you understand what's going on. So there you have it. We've covered the fundamentals, we've walked through a complete problem from start to finish, and most importantly, we've exposed the most common ICAI traps. You now have the complete toolkit, so the only question left is, are you ready to make your cash flow statement tally every single time?